Hi everyone, this is Nikki and you're watching this awesome 10x market update this July 8, 2022. Yes, this is a free Friday class and this is what we offer our clients, our awesome 10x members who want to get that daily membership, that daily class every Monday to Friday. The Friday is a free class which we do so that you will realize the value of our market updates. And even if you are just watching us every Friday, we hope that it helps you keep in touch with your market portfolio. And I have a lot of things to share for this 1 hour. Hope that you like, subscribe, and share this to your clients, especially at this opportunistic time. So let's begin. Let me go through what I want to share to you guys, which is this one. Wait up. Am I sharing my screen now? Wait up. This one. Okay, let me share this one. Approaching the next 3 months where fortunes are born. It's July 8th. That means that within August, September, or October, I am predicting you will get some fortunes. Well, fortunes are born. You don't reap yet. You will just sow a few things within the next 3 months. Now, data helps inform my investment and trading decisions. Long term data is essential, but history can only guide us, they will never take away the risks. So we're going to use data from the past to try to predict what's going to happen to the future. But as Mark Twain says, it never happens quite like you think. History can rhyme, but it's not the same. So what we do know is that long-term data tells us the bear market is always a golden opportunity for companies to separate themselves from the pack. You've got 5,000 and more companies who's setting themselves up for future success. How these companies navigate the bear market and the recession and how you navigate it will separate you and your future from the pack. In a bear market, most institutions and retail funds have less capital to deploy. That means that you have to be very selective with deployment, evaluate with higher skepticism and selectivity, and you want to buy companies that you really believe in and you want to participate in for the long term. Meaning, even if you're trading in the short term and or the long term, you will have criteria. Now let's take a look at some industry metrics. Video game sales are setting to fall for the first time in years as the industry braces for recession. A lot of people are already forecasting a contraction on global video game sales to $188 billion. This has, of course, expanded during the pandemic 26% and has grown since 2015. However, a lot of analysts believe that the game industry is not recession proof. This has already taken a toll on some companies like Unity Software and Roblox, tanking 70 to 80% this year. Now, the question is, after a rally these days of about 50% last month, do you think that Roblox and Unity are set to fall another next 3 months? My answer is that it pays to watch, and we will have to watch out for those industry metrics. Now, I'm showing to you the Wilshire 5000 full cap price index. This is, in my view, bigger than the S&P 500 because it is Wilshire 5000. So this is also comprehensive data coming from sources Wilshire Associates. You can see that the markets in the very long-term data is obviously upwards. Therefore, a bear market, although it is very scary, is actually the most opportunistic time for anyone with cash to really buy some stocks at a very cheap valuation. Now, what you don't see here though is that bear markets like 2000, 2002, which lasted 3 years in the NASDAQ bubble, as well as the 2008 crisis there, actually lasted for at least a year. So you have actually averages in the realm of 11 months to 36 months. So assuming that you would consider 2021 your bear market, 2022 another bear market, it will only be 2023 where you will actually see a bottom. Then again, the markets usually bottom 6 months before the actual bottom. So if you think that the markets will bottom around 2023, you should be looking at opportunities this next second half of 2022. Significant drops have happened, significant blood has been shed, but looking again to history, usually you will fall 50% from the peak. And during the 2001 bubble, it was 75%. For the reason because, well, the NASDAQ, during that time, you've got the Amazons of the world not being the most profitable companies indeed in the world. So there was a massive sell-off of about 75% on average on the NASDAQ. Now take a look at the Wilshire here. Although you can't see this straight, this drop here in the 2001 bubble, on average, every stock would have declined 50% from the peak. And that is average. It means that some stocks fell 80%, some stocks may have just fallen 30%. So on average, most stocks fell 50%. So if you're going to take a look on the valuations, you want to make sure that if you're buying anything, at least 50% off. Now, it's also the same thing here in the 2008 crisis, at least 50% off. So if, example, you're looking to buy the NASDAQ index, the QQQs have to fall at least 50%. That means that 16,000 to 8,000, but your NASDAQ is at 12,000. Does that mean that it will happen? Is it a self-fulfilling prophecy that we are looking at? Yes and no. The thing about data is that it doesn't have to happen. But if so many people are looking at the same data, what it means is that the little money that they have is going to be left to buy that NASDAQ 8,000. So here, NASDAQ 12,000, you're seeing that rally. We look at it actually as an opportunity to still continue selling. Now, this is the Schiller PE ratio. Let us explain what is this Schiller PE. Schiller PE is coming from the Nobel laureate, Robert Schiller. He says that the PE ratio where everyone is looking at is not as good because it only looks at 1 year. How about using a PE ratio versus the last 10-year average earnings and actually changing that towards inflation? So there are, of course, limitations of that, no? It says here that the Schiller P ratio is backward looking. You have no idea about the economy or the economic policies involved. Obviously, if you have quantitative easing, you'll have very high P ratios. If you have quantitative tightening, less liquidity equals lower and lower P ratios. That said, these indices and these data points aren't really the buy signal or the sell signal. It is just for us to rely on how we can find many metrics to help us invest or trade. Now, it's nice to say that this is an S&P 500 Schiller PE ratio, wherein if you just look at the lows during the 2008, 2009, the Schiller PE ratio was at 15. However, the PE ratio today is still at 29. So that could be a skew, that could be expensive today, skewed by the fact that your FANGs are very expensive still. You've got Tesla still trading at $700 billion. You've got the Apples of the world still trading at trillions of dollars. You have a lot of expensive pricing right now still in the FANGs, in the Amazons, because they are still just dropping less than 30%. Some 30, some 40% for the year, but they haven't dropped as huge as the rest of the growth stocks have done. So if there is blood that is left to spill, my sense is that the bearish funds will still continue to attack your Googles of the world, your Apples and Amazons and your Teslas and your Microsofts, yes, if they fail on the earnings, which is coming out next week, next week. Your banks are reporting come July 14. Your Tesla reports July 20. Your Amazon reports July 27. And if I were you, I'm not scaring you, but with Walmart and Target telling you that there is significant inventory, and that's just, apparel, cyclicals, what makes you bullish on the Amazon Prime Day sales to assume that Amazon at about $2,200, $2,300 prior to stock split and approaching 2,400 is gonna be sustainable? So we look at metrics, and with a quantitative tightening to come, you have to reevaluate whether the market is finished with a bloodletting or it was just a bear market rally and then we fall again. So this is the CAPE ratio. The CAPE ratio is the share prices or the S&P 500 versus the average earnings over the last 10 years adjusted for inflation. This data is used in Irrational Exuberance, Princeton University, Robert Schiller. So we take a look at February to July. You could see that the February cyclically adjusted P ratios have dropped from 36 times to about 28 times. Now, if you want to say that, okay, maybe 20 times is enough, you're still waiting for a 40% crash. I mean, 12,000 minus 4.8. That's really looking at about 7 to 8,000 NASDAQ. Can it happen? May it be happening? We aren't sure. Nobody is sure. And I'm not here to scare you. But these are significant metrics to infer where will the bloodletting come from. I think that Apple is one that will be sold down. So here at about 146 at 155, you can theoretically do one thing. Make a bearish spread. How do you make a bearish spread? A bearish spread means that you buy 155 put and you sell 130 puts. Why do you have to sell a 130 put on Apple? Why not sell a 100 put on Apple? Okay, the thing about selling puts is that it is writing an insurance. When you write an insurance, you receive a credit. When you buy an insurance, you pay a debit. This bearish put spread that you can create on Apple tonight or on Monday or on Tuesday before the Taiwan semiconductor manufacturing data released is something to protect you. Now, how does it protect you? Well, if the markets indeed sell off, obviously your buy puts will print money. Your sell puts will not print money, but it will go up because the Apple will go down. Nonetheless, the rise in sell puts is gonna be negligible versus how much these buy puts will print money. Now, if you are really risky, how about not doing the sell 130 put? Just do the buy puts. That's fine. The only reason why you are doing this sell 130 put on Apple is because we think that no matter how bad the data may come, we aren't sure if we can get Apple at $100. Maybe there's always a buyer on Apple at 129. And the reason is why? Because Apple's ecosystem is not easy to demolish. You've got a moat. You've got how many billions of devices running on Apple, which will continue to make money on Apple Pay. They've got $200 billion in cash balance sheet that they are now deploying towards their buy now, pay later, which will obliterate companies that are smaller like Affirm. You have a company here that's Apple that will have a slowdown but will not collapse. And to determine how cheap Apple will be that people will come in swarms to buy, we can only infer the following things. We have a support at 130, we have another support at 125 and 120 and 100. Now, if you will argue that the index has to fall tremendously and you are a Michael Burry who's shorting an Apple, I do not object with your bearish thesis. It's just that from a downside perspective, Apple obviously is very hard to sell off. It is not that easy to make it go down because it has the best business with the best moats. It's very difficult to sell down an Apple and a Google. So the market will do its best to sell NASDAQ from 12,000 to 10,000, but let's not predict that we can really make it go 9,000 or 8,000. It's not going to be that easy, but the bearish trend is intact. So I will say yes to the ones who wants to buy a bearish put on Apple, and we can do a bearish put spread. That's how I'll navigate this Apple conundrum for next week. Now, speaking of Warren Buffett, we know that Apple is also being bought by Warren Buffett. And we know that one of big purchases of Warren Buffett these days has been Occidental Petroleum. Now, a lot of people may say, but energy stocks are toppish. They have run up way too much. Except when you look at the last 8 years, Occidental actually got down from $98 to $9, or a 90% decline over the last 7 years. It seems as if Occidental Petroleum was being priced as if it was going to be bankrupt for all the reasons that there was a negative oil. For the last 10 years, people all suggested that there is going to be a climate change and we have to obliterate all the oil drillers in the world. And because of that underinvestment in energy, nobody was doing that oil and gas drill exploration, such that if Russia and Ukraine had a war, now we have $120 oil, which we think, albeit it fell to about $90 and $100, it is still likely to remain expensive. Production fundamentals have never really gone up over the last 10 years. If there's a reason why we have an energy crisis today, it is a function of two things. We underinvested in energy names, and we overestimated our capacity to replace these with solars, nuclears, and all these renewable energy capacities. So although it's a great thing that we want to go solar, the time frame for now to go to solar might take 10 to 15 years. And so if you're going to say that's going to take 10 to 15 years for us to go at least and match that solar, you look at the world energy right now, people are discussing about 70-80% is still oil and coal and gas. So the Pareto rule states that you have to buy Occidental Petroleum, especially if it falls $50 or $40 or $30. If you can buy it like our boss Buffett at $30, the beautiful thing about Buffett is that we can always just catch the bottoms or just buy the lower lows or the higher lows. It depends. Do you see it as a lower low or a higher low? In the short term, 70-60 looks like a lower price. But in the 1 year time frame, you know what? $40 versus 10, you're buying it 400% higher. And yet $40 is essentially 50% below the 2014 prices. And mind you, Occidental apparently trades at 7 times PE ratio. At this point in time, anything less than 10 times PE ratio is considered a buying zone, especially if you have an energy crisis. Now, a few things to understand. Last month, Biden actually implemented a nuclear plan for the US. And that actually spurred a company like Yu Energy Fuels to go from $5 to $7.50. And then recently, because the commodities are falling, we see uranium stocks falling down like a precipice, going down to $5. Now, unlike oil and gas, where we are already using it, uranium is still a policy framework within China, within the US, within Europe, and Japan, and so on. You may actually get a fortune when energy fuels drops down to $2, because who am I to predict that this is already the bottom, right? All I can tell you is that fundamentally, if the world is going renewable energies and nuclear plants are reopening, whether in California, whether in China, and all across the world, you have to pay attention to these stocks. This is a potential 10x mover. So you want to take a look at it. Now, because the market is toppish, there are companies that are trading at overvaluations. One company that we found a little bit interesting to short is Celsius. Celsius is an energy drink. It is a consumer defensive. Now, you might argue a Coca-Cola, even if you rise $1 to $1.25 per can, nobody cares a damn thing. If they want to buy their Cokes, they will buy their Cokes. It is the same thing for beverages like Celsius. If you are used to pay $1, even if it rallied to $1.10 or $1.20 price a can, you don't really care. You will still buy your drink because it helps your energy, metabolism, and makes you lose weight. Wonderful product. Nonetheless, Celsius is trading today at 600 times multiple, $80. I'm not saying it will crash to $8. All I'm saying is that, will it trade high? Well, it's trading today at $2 billion. If some people drink, maybe it can even rally to about $5, $6 billion. Will it go all-time highs? Maybe yes, or maybe no. For me, I'd rather be on the short side here. $80 to $110 looks like an entity to short. Elf Beauty, oh my gosh. This is trading at nearing all-time highs as well. For 2022, trades at $33. Elf Beauty also trades at 70 times multiple. Now, some people might say, but Nikki, a P/E ratio is not enough to say a sell signal on a company. Yes, but if the other entities like Estee Lauder, if the other industry big giants like a Coty is having a hard time, and the consumers are actually having to pay 40-50% higher gas prices, 40% higher mortgages, I know that you want to be beautiful, and it may be just a cheap thing. People always say lipsticks in a recession is actually resilient. Beverages is a resilient thing. Having an opinion is also okay to be wrong. Okay? I'm not saying that I'm right, but I am skeptic about these all-time high movements in Elf Beauty. Now, MongoDB, why would I want you to short at $346? It's $315 today. This is not even earning money. It is negative. It's loss making for now. Sometimes it makes money, traditionally it does, but it trades always at 20 to 40, 50 times price per sales. Yes, you heard me right, price per sales. A few years ago, people would not pay price to sales metrics. And yet, due to the quantitative easing, companies like this was able to exist, making those lavish returns. Something like 10x over the last 4 years, from 2018 to 2022, from about $40-$50, it rallied to as much as $600, and still today it's still trading at $350. We're seeing a lot of technology companies lay things off, lay people off. At some point, if there will be less technology startups there will be less clients. So there should be a few people here that would short $350 for MongoDB. And that would be us. People who don't believe that 20 times price of sales will be sustained in a recession. Now, a lot of people have been discussing oil stocks, stoppish, oil stocks, commodities have peaked. Are we of the camp that believes that commodities have peaked in the long term? Unfortunately, I don't believe that rhetoric. Your production over the last 50 years didn't go up. Your production of oil barrels only increased by a little miniature of 20% over the last 50 years. That means that your marathon oil or your EOG resources, which are trading at 10-year lows, will still continue to trade high, in my view. So example, Marathon Oil Corporation over the last 10 years traded at $34. Over the last 8 years, people thought that energy stocks dropped 90% because they were going to go bankrupt. Bankruptcy with negative oil, with a lot of debt. What's going to happen to your Chevron, your Petron, your corporations like Shell? They cannot even pay dividends during pandemic. Of course, after the pandemic reopening, when the COVID boosters happened, when we were vaccinated, we all went out of our houses. And when we left our houses, we didn't ride an electric vehicle. We still brought our internal combustion engine vehicles. We still drove our cars, and we still drove our prehistoric cars. Now, it's nice to say that a lot of other Americans and other Chinese and other Europeans are already driving EVs, except that in a 1 billion vehicle world, you're only tapping 1% or just 10 million vehicles sold worldwide. That tells you that there is very, very big opportunities for EVs, and there is still a lot of money left for the ICE vehicles to run on oil. So maybe over the last 10 years, when we underinvested in energy, the world realized it is a huge mistake. So for the next 10 years, expect the following. Oil companies will not go bankrupt. Obviously, they will continue to earn a lot of moolah, and that money will become either reinvested to more oil drillers, and they would be continuing to reinvest in these oil drillers and explore more oil in Texas, in other parts of the world, even the oceans. So my view is that this year, Marathon went from 14 to 32. It can fall, that's why this is now 21. But if you give me a question, should I buy it at 14 here? I believe that the buyers at 4 and 14 are correct. So Marathon Oil, if it drops next month, next 3 months, fortune comes to the bold. You make fortunes as well buying some energy names. These are your energy stocks, the top 6 companies of the world in the oil and gas exploration segment. You've got ConocoPhillips, you've got EOG Resources, Canadian Natural Resources, Occidental Petroleum, Pioneer Natural Resources, Devon Energy. What can you say about this chart in a single glance? Number one, they all look alike. From October to the rise of June, it all rallied almost 100%. ConocoPhillips 60 to 120, EOG 60 to 140, CNQ 30 to 70, Occidental Petroleum 30 to 70. Pioneer Natural 140 to 280, Devon 30 to 78. So in other words, whether you buy one stock or 6 stocks, they move the same. They move up the same, they go down the same. And when you look at all their P ratios, they're all trading 8 times multiple, EOG's 14 times, CNQ's 8 times. So if you ask me, if you can buy ConocoPhillips at about 70 or 60, maybe you should. If you can buy Occidental Petroleum at about 40 or 50, maybe you should. Maybe, just maybe, this inflation peak narrative is a decoy, a noise, just for the markets to rally for a few days, a few weeks, and then to fall down yet again. I bet every American and every person in the world does not expect the gas prices to really go down next 3 months. Or if it goes down, the pricing per liter is only gonna fall temporarily in the short term, only to go back up again next year. Because unless we are producing oil and unless you're telling me that the war in Russia and Ukraine can end by next week, then I should see shortage and inventories continue to be a problem. This is your HES, your FANG, your MRO, CLR, CTRA, EQT. These are the next top 6 exploration of oil gas companies in the world. Same thing like Marathon Oil, right? It's just that the smaller the company, the larger the moves. For Marathon Oil, it went from something like $10 to $30, and it's dropping to 21. As I said, a drop at 15 is a great temptation to buy MRO. Of course, you can study Devon. 80s went to 160s. If it goes 80s, of course, we would be a buyer. Okay, so these are your top oil and gas exploration companies. You can choose from your liking. Chesapeake Energy, most of these are in US. So that means that US is also actually producing more than Saudi Arabia, but it is not enough for the world. And that means that we would need to keep on exploring worldwide. Now, a few things to state. Among the companies that is rallying these days is Affirm Holdings, the buy now pay later company of Max Levchin, PayPal Mafia. This has nothing to do with whether Max is a great manager. This has nothing to do with whether buy now pay later as a business model is wrong. But look at the following things. You've got a rising interest rate environment for the next year because of high inflation brought about by oil because of the underinvestment in energy crisis. Affirm Holdings seeks to help credit cards and seeks to help you to buy now and pay later. Unfortunately, what we are seeing from a lot of data is the following things. The following things are happening today. People are overusing their credit cards to cover the payments for buy now, pay later. People are actually struggling. You've seen Klarna 90% down after valuation. You've got a firm 90% down, rallying back 80% down. We know that if the people cannot pay, that debt becomes a loss, a default. People today are living over overdrafts, credit cards, using it for repayment. Now, buy now, panic later. In UK, the Gen Z is buying now and paying later, and shoppers are overwhelmed. 50% of them have not been able to afford repayment. 8% of them have already been contacted by debt collectors. This data comes from Barclays. And a few things. If you measure bad debts as a percentage of consumer loans, Afterpay has been leading the pack to 14%. Yes, Afterpay, the company that Square bought. That's why Square has been suffering because of Afterpay, not because Square has suddenly run out of payments to process, but also that's the following reasons too why Square has been underperforming the overall fintech sector. Now you've got Zip, 9% consumer loan bad debt. Klarna, 8% bad debt. Um, Meanwhile, the banks have been reporting so far a bad debt of about 0.31%. With high potential losses, very low margins, you may never make a profit no matter how much growth is achieved. The buy now, pay later apps have been enjoying record low interest rates, but it is now turning upwards, making any path to profit impossible. Basically, every dollar of sales now goes straight to losses. So if you're wondering why a firm has fallen straight downwards and is almost like a seemingly bottomless pit, I believe that right now a firm is just like Robin Hood, wherein the value of a firm is for the potential buyer and not being valued for its actual earnings or losses to begin with. When you're a company like a firm, who can buy you out? Shopify could, the largest merchants could buy you, just like what Square did to buy Afterpay. The largest merchants like PayPal can actually buy a firm, but I bet that they would only buy it at a very fire sale price. So the way I see it, a firm is still a sell if it rises to $30. What with Apple being now their competition? If you've been reading the news, you now know that Apple, with its $200 billion of cash, can now use their balance sheet cash not to buy and acquire any company out there, but to use it to lend to people for that buy now, pay later program as well. And unlike a firm, everyone can actually use AI. That's the thing. The banks can use AI to lend credit to you. So I think that the moat of a firm is slowly getting sold off and sold off. It used to be that there were so many companies. You were the first you were a first mover, just like what Nokia and BlackBerry used to be in the cell phone business until iPhones came around and basically obliterated them to nothing. I'm not saying that a firm will become nothing, but all I'm saying is that it is very tricky on what's going to happen in the next 5 years if you've got a higher interest rate and if you've got a company like Apple fighting you, and if you've got big companies like Square who has a merchant network already to basically tell their users to use Afterpay instead of yours. So there are some companies that have been implementing buy now, pay later. The only way out that I can see for a firm is either PayPal buys them or Shopify buys them or Amazon buys them. So I don't know who's going to buy it, but I think there's value in it. I just don't know what's the proper payment for it. So right now, all I could see for a firm is it is a trading range. You buy it at 15, 16, you sell it at 32. If it goes up to 32, it is a short area. How about 24? At 24, 23, I think people are already starting to sell some because as I said, that is a 50% jump in the last 3 days. 16 to 24, 50% jump. Of course, it can go 100% jump too. But that, in my view, is a short squeeze play. And there is a valid reason for a firm to be questioned if it rallies all the way 30 to 50s. As long as there is a clear use case and a true market fit, the businesses, in my view, will recover. In my view, there are fake valuations and there are still real values in the world. One business that I think really got undervalued today is Facebook, also known as Meta. Amongst the FANGs, this dropped from 380 today to 170. But it does not mean I know the bottom. I just know that no matter how choppy Facebook goes, there's always a margin of safety when it gets violently sold down. Unfortunately for Facebook, the earnings comes out only in August, right? So how can Facebook prove that it's still earning money when everyone is so focused on them losing $10 billion over on the metaverse? And with Zuckerberg obviously talking about laying off the engineers from the metaverse, the underlying difficulties of building the metaverse and the advertising dollars that will come from it, the skeptics are correct to question. But at the same time, I think if this company is churning out billions of dollars of revenues and profits, which will be shown because their Instagram apps nor their reels didn't really lose out from TikTok forever. As I said, if there is a clear use case and a true product market fit, the businesses will recover. The funny thing about Meta is that it got sold down even if the business didn't lose money. They didn't lose money. They are still digital advertising dominants. This FB and Google are dominant. But you could see that Google is just dropping 30% from the peak. Facebook, aka Meta, has fallen way to the offside. To me, a drop on FB to about 120 or 140 is a great sign to buy. You can see a resistance right now at 185. In the short term, I really think there's value here. But over the long term, short term, long term, there's clear value here, no? But we have to follow the fact that if Nasdaq at 12,000 or 13,000 is going to be sold down, the sellers of Facebook, I don't think is a fundamental value investor. The Facebook seller is who? The index manager, my golly, guys. The sellers of Facebook, Tesla, Apple, Amazon, Microsoft are simply index players, the people who are shorting the futures at 12,000 and 13,000, the sellers of your QQQs, the buyers of SQQQ. And therefore, because Facebook, aka Meta, is a primary index product rather than a digital giant play, it will be sold down from 185 to 200, and the drops might be mitigated at 160 or 140 or 120. And because I just want to be barat, in the Philippine term, barat means a cheapskate, well, I'm going to try to buy Facebook at 120 if I can. The best businesses are not screened on which company fell 90% down or 80% down or 95% down. The best businesses are the ones that make sense to you. Because even if I say Disney's a great buy at $90, there's a company that is selling for $1 that is a great 10x move, you may not believe it if it does not make sense to you. So when push comes to shove, even if Facebook falls 40% below, I believe that you should be able to get it and not feel a damn thing about it, except to be happy that a recession fear is where the corporate earnings will fall, everyone will allocate less and less dollars. Coca-Cola will not advertise too much. Starbucks will not advertise too much. Corporate advertising budgets will fall down in a recession, knowing that you wouldn't shop a lot. But just like recessions are come and go, cyclical, that means that the drops is going to be a good news for the people who have cash. Now, why are recessions inevitable? Okay, we can see that for the last 70 years, you've got a recession whenever your unemployment goes up 10%, 15%. And whenever it hits that unemployment rate, the world is so scared, and that scare makes people like the Fed basically ease the interest rate hike. So actually right now, the world is still at less than 5% unemployed. And people are still okay with it. And they're saying, oh, we're not in a recession because the unemployment, people are employed, people have jobs. Except that the unemployment rate, guys, is a lagging indicator. This is a lagging indicator. Take note that in 2008 crisis, the unemployment was 5% and it rose to 10%. You don't just lay off people immediately. It takes a while. So when the unemployment goes up from something like less than 5% to 10% next year, are you going to panic next year or are you going to panic now? The markets panic a year before. That's why when you see next year, recessions, headlines, unemployed 10%, that's the time that you will see na magugulat ka na lang, the market is already rallying on that bad news because the market is leading. This is the leading indicator, not the laggard indicator. The leading indicator is the layoffs. So far, 915 startups are laying off. 150,000 employees have been laid off since COVID-19. The blue signal here is the new layoff events. June 2022, you've got another layoff. July, August, September, October, November, December 2022, you're probably going to have a very difficult economy in the next few months and the next year. That's why do not fall into the trap that this is over. We want you to be prepared for more sell-offs next few months. The same way that happened during the pandemic, except that the last time this happened, the market was printing trillions. Nowadays, this layoff, we don't have a printer from J. Powell. J. Powell is actually taking off liquidity as we speak. So the following things happen. During the pandemic, because of the printer money, a lot of establishments continued to remain open in business. They even tried to hire workers. There are 10% more businesses. Shopify had a lot of merchants. People opened whatever e-commerce business they had. The growth rate in open establishments versus employees since Q4 2018 was said to have risen. So that was a rise in business. Now, during the pandemic, there was a drop. A lot of employees were laid off. And nowadays, even if there is, what they're saying is that there is a lot of people employed, we only just got back to that 0%. Meaning people were hired because we reopened the economy. You've got pilots, you've got waitresses, you've got a lot of people getting hired again on theme parks and casinos. And yet, some businesses that were opened will have to shut down. So this 10% difference that you are seeing would become the layoffs of the employees. This is the same as the 10% that you saw in the pandemic here. 2.5% growth, 8% decline. So there is that spread. That 10% has never been gone. So you see businesses from 9.8 million in 2018 grew 10.8 million. That means that over the last 3 years, especially during the pandemic, 1 million new entrepreneurs. But how many small business entrepreneurs can continue to grow? If you wonder and ask, why is Square, why is Shopify just trading at 70% below their peaks in the pandemic? It's because these small businesses are not expected to renew their subscription in Shopify. They may not be able to sell a lot of services that they might actually unsubscribe from their subscription to Shopify. That's the question. Now, inflation is not ending, in my view, because I also think it is not caused by war. Biden and Trump pumped a lot of money. Jay Powell did, a lot of them. Ben Bernanke, let's not blame it on Jerome Powell. That is recency bias. Everyone, Janet Yellen, Ben Bernanke, Jerome Powell, the central banks all over the world pumped a lot of money. So far, there is $63 trillion debt in US. The personal income is $21 trillion. Your entire world is leveraged. Therefore, deleveraging the economy is going to be very painful. So there's the 63 trillion debt bubble. Thank you for the sources in US. You could see that this is skyrocketing from 1950s to 2020s, from about 0.6 trillion to 63 trillion. So we went 100x our debt. And yet, that's fueling this inflation. That's why from the 1970s, where you've got that 7% inflation, you've got this 8% inflation. Maybe the Fed can do something about this. Interest rate hikes are already making other companies lay off people. So it means that it's working. The 75 basis points hikes and the rate hikes are already working to tame this inflationary number from 8 perhaps to 7 or 6 or 5. A lot of companies are already defaulting and closing down. Now, the buying opportunity is the following things. You are seeing that 300% debt ratio versus your inflation rate, it could fall, right? Traditionally, what happened during the 2008, from 274, it fell to about 254%. I don't think that we can really go down from our debt binge. From about 300%, maybe it goes about 250%. There will be the leveraging involved. Maybe housing crisis can crash, housing prices can go down. And we see buying opportunities will not happen in a single day. It will be months to years. I have 15 minutes left. Give me time, and I will continue this next week. Don't worry. But the opportunity is global. You've got the leveraging worldwide. We're talking about low interest rates fueling asset bubbles, not just in US, but worldwide. Maybe there is a China housing crash, a Philippine market crash, a European crash. It's a worldwide event. To be honest, the Philippine stock index rally is a fake one. I was saying that 646572. We continue to say sell. There is no problem to keep selling. You have this massive deleveraging problem. You have the dollar skyrocketing. The data tells us it is not yet time to go buy the stocks. Not yet. You're just trading. It's not yet a buy all in type of stock. No, you're just trading. Now, a lot of people are saying housing downturn is not the same as the 2008 crisis. It's not the same. We don't have the subprime, agree. But even if we don't have the subprime, we're already seeing people complain about inflation. We're already seeing that housing is a cyclical asset, just like commodities. And housing prices have gone 300% up over the last 10 years. And people cannot afford it. Zillow has dropped from about 200 to 35. Can it go down 90% towards $20 back to these 2020 lows, back to these 2016 lows? Zillow makes a money when you are buying or selling a house, when you are renting, when you are doing a lot of property activities. If you think that in a recession, there is a lot of property activities or sales, I don't think so. And the reason why the market sold it off was because in 2020 to 2021, 2022, perhaps this $50 to 200 was all the bubble. The 50 to 20s is where you are just in the cyclical trading range. So you're just in a trading range. Zillow is not going to go up a lot. It's not going to go down a lot. But at 40s or 50s, you will want to sell it further because you don't see this housing market go to the moon. It's the same thing with SPACs like Open Door. From $40, it's now $6. Can it go to $3 or $2? Whether you believe that there is value to be made because the housing crash isn't real, the point is that makisabay ka sa primary trend. If the world believes that you are in a recession, the world will also have less appetite to deploy in buying a house unless it is at bargain values. So you've got people, let's think about the housing construction. If there will be less people who can afford a house, that means that there will be less and less people who can also afford to go to construct their own houses. They will delay. They will be just renting it out if they can rent. They will not buy a house because they cannot afford. Not because they don't want to buy a house, but they just can't afford it. And because interest rates from the banks are very high, they want to buy a house. They just, as I said, can't afford. Layoffs equals inaffordability to buy a house equals lower transactions for construction, for housing construction businesses like D.R. Horton. So D.R. Horton rallied from 30 to 110. Unfortunately, it may go back to 50 or 40s, back to the trading range. So there's still downside for D.R. Horton. Still a lot of downside for Lennar. Now, people said, The reason why we have this housing bubble or crisis is because there's very few production of houses. There's very few constructed houses. Now you ask me, the reason why people cannot construct their house is because they don't have savings. If they are already defaulting on their credit cards, how many people do you think can actually afford a house? Will you construct a house if nobody will buy it? Will you tie up your dollars, precious dollars, into constructing a house if you're Lennar? You won't. It is a chicken and egg problem. So, with higher interest rates, unfortunately, housing sales or real estate sales will be lesser and lesser going forward. So that means that as it approaches $90, I don't think Lennar can escape the downtrend. Could go to 70s to 60s, 50s. It may not crash like Zillow or Open Door because again, we need to construct houses. But the big problem, I guess, is people don't have enough money. I think the only way for the fiscal policy to make these houses is the government has to pay Lennar, the government has to pay Dr. Horton to make the house. Government housing could solve the problem, perhaps. So with a potential lower lows for your homes, more lows for lows, which are your furnishings, right? So Lowe's companies to 60 to 180. Maybe this was a pandemic boom. People were in their houses, they were refurnishing, remodeling, repainting. Looks like it could go down. 180 could go 160. Any rallies of lows, more lows. DWAC to new lows. Okay, we are talking about companies that we are bearish upon. We have been bearish on Trump's Truth Social since it got listed. Ever since this 110 and 100 and every rally in between, 70s, 50s, 40s, 30s. If DWAC rallies to 30s or 40s, the thing is, nobody is even in their social media platform. So who are they gonna be advertising upon except the Trump supporters? Okay, I just think that there is no business model, and zero business model means zero. Home Depot, 420, 280, maybe it goes 240 or 200. Lots of downside here. Redfin, similar to Zillow's business model, also dropped 90 to 9. Amongst the three of them, Zillow is the leader in the pack, right? But the leader is already down 90%. Should this go 95% down? Could be. Now, real estate, the mortgage rates have gone from 3% to 6%, up 90% from January to June. That means that everyone cannot pay their mortgages. They have to pay higher. This impacts the consumer spending. This explains why Nike sales are flat. This explains why Amazon in the next coming months, in my view, will not have a great quarter. And this also underpins my view that retail will continue to underperform. Consumer items, the reason why Bed Bath and Beyond, you want the candle, but you can't afford the candle because it doesn't make sense. Why would you buy a candle when you can't even pay your rental? So the DJ US Home, same thing. The reason why people cannot, that's the reason why you have a 35% drop in the houses is because mortgage rates are spiking. If people cannot buy a house, they cannot construct a house. So they end up becoming renters, and that makes the poor wider and wider versus the rich. Because those who have a home theoretically will become wealthier next 10 years. That's the sad fact. If you can't buy a home, then you become poorer and poorer over time. You cannot capture the opportunities that will come for you. So these holdings, DR Horton, Lennar, Pult Group, Home Depot, Sherwin-Williams, Lowe's companies, Top Bill, Toll Brothers, Masco, unfortunately, probably lower lows in the next 6 months. Now, is the housing market really in the same crisis as the Great Recession? There's a few things to be a little bit bullish upon. Number one, because of the 2008 crisis, the credit quality today is more strict, i.e., there will be no ninjas. We didn't lend money, the banks didn't lend money to people who will default. These people have an income, they have a job, so they will less likely default. So far, on paper, because of the people who bought a home in the last 10 years, they still have $11 trillion of home equity, which they can sell if they wish. Now, the total mortgage debt is also less than 43% of current homes, the lowest on record. This means that the people who bought a home actually could afford that home. And just 2.5% of borrowers have less than 10% equity in their homes. They really paid for it, no? 43% less na lang yung current home, no? So talagang halos lahat naman ng debt bayad. There are currently 2.5 million adjustable rate mortgages. ARMs can be fixed, usually for terms of 5, 7, or 10 years. This means that even if the interest rates are spiking from 3% to 6%, a lot of them were able to fix their rates for 5 years, 7 years, 10 years. Some of them were able to do so. In 2007, there were 13.1 million ARMS, the adjustable rate mortgages, no? Now it's just about 2.5 million. So if there's going to be defaults, it's just these 2.5 million people, not like the 13 million here. No, a lot of people were able to make a fixed rate rather than adjustable. So since 80% of today is operating under a fixed rate for the first 7-10 years, that means they are unaffected even if the Fed raises the roof on the rates. No, that's the beautiful thing. Today, there are 1.4 million ARMS already adjustable, basically adjustable mortgages facing higher rate resets. These would have to make higher monthly payments. But in 2007, this was 10 million. So if there's going to be default, it's just going to be happening to those 1.4 million. If you're wondering, can the banks fall down yet again because of these defaults? Apparently, the mortgage delinquencies will be lower than before. Now, in terms of pandemic, there are still 650,000 in the mortgage forbearance programs, and so far 300,000 are delinquent upon these 645,000. So if you're talking about the delinquency rate, perhaps it's not going to be as big versus the 2008 recession. Now, there's also a following thing to remember. In a recession, stocks fall, corporate earnings fall. Therefore, if you have to do your PE ratios, it has to be cyclically adjusted, as Schiller said, no? Robert Schiller. Robert Schiller is a Nobel laureate, a professor of economics at Yale. If you're going to do your PE ratio, take the average of the last 10 years of earnings, adjust them for inflation, and then divide the current price by that adjusted earnings so that you are really valuing the company over the business cycle rather than just one bad year. Remember, in the Philippines, there was a time when companies like URC traded at 4 pesos. And why did it happen to be? Because some people thought that it will never earn money after losing in the bonds on the Lehman Brothers. If you still recall that 2008 crisis event. Now, you have to take into consideration some companies will default this year. But if that is just a one-time default, let's say the houses, the mortgages, there are some banks, there will be delinquencies. Maybe a firm, there will be high delinquencies. Perhaps, if you think that the business can survive, then that is also the best stock to buy after a while, because you have to think of it as a business cycle, not as just 1 year. At the same time, if you think that the energy stocks, which had an aberration during 2020, right? Occidental Petroleum went $9. Will it ever go down to $9? No, because the next 10 years, energy is still a shortage and we'll still have this $100, $90 oil for the next 5 to 10 years, or maybe the next 3 years. Since that is the case, that means that energy stocks is cheap. That means we will buy Occidental and we will just follow Lolo Buffett. Apparently, it's the following things. I recently went to Six Flags and I did ride this. I really experienced this Extreme Ride X2. You can see that Extreme Rides, all I can tell you is that the tip of my relative was try and focus to go for the hardest first. So the first open of Six Flags, we were very early there. It will open 10:30 a.m. We went there as early as 9 a.m., 9:30 a.m. just to make sure that we can be ahead of the line. We start to focus on the hardest things first. In a bear market, the hardest thing for most people is to find where will I put my money. In the Six Flags ride, I had to go, which ride is the longest line, no? Because it's the best ride. It was X2. So we focus on the first thing. We know that in a bear market, everyone will focus on buying the best businesses first. So the truth of the matter is that, so I like this ride. This was, sorry, the X2. This was the X2. This was Tatsu. So we rode that two first. This is the full throttle. This is Goliath. Most people are afraid of the plunge. But I want to tell you this. Once you finish your hardest rides, your first plunge, your first thrilling Six Flags ride, for those who love roller coasters, I need to make the analogy here. Everything else is easy, honestly speaking. If you've seen the year 2001 crisis in the NASDAQ, if you've seen that bear market and global financial crisis, 2022, 2023, whatever they call about this recession, depression, it's a cinch, guys. It's a cinch. This is going to be easy. So the employment and earnings will be the main ideas for next week. I am bearish, but I do not believe all stocks will hit new lows. So I feel that some companies already underpromise. They will probably, some of them will overdeliver. Next week, Delta Airlines may actually be a bullish surprise. It could rocket up your Airbnbs, your Marriotts, and your Hiltons. How do we know this? Data, anecdotes. Last July 4th, 48 million Americans went out for a weekend. They were watching movies. That's why Minions, Rise of Gru, did very well. This may actually show a boost to Disney, Six Flags, your hotels. Now, I do not know if the banks will report a decent quarter. But if mortgages aren't delinquent, if credit cards aren't delinquent, maybe JP Morgan and Goldman Sachs, which told the world that there will be an economic hurricane, will end up to be, it's just a normal recession. You may get that rebound until July 13, 14, 15. So next week, we could still be happy. But I will have to tell you this. The companies would have to be dictated by the next moves. Not just this quarter, but the next 6 months, the next year. So I think that right now you're in an intersection where earnings will validate whether you are right or wrong. And there is an uncertainty principle. The uncertainty principle is that if people don't know, they will hedge. Just like me, I don't know, I will hedge. Next week, you've got Taiwan Semiconductor Manufacturing, and you already saw Micron, Micron Technology already said that, hey, the shipments for PCs and phones might be lower next few quarters because we didn't get the amount of orders like before. So I have to tell you this. Be careful next week. I'm bearish on Taiwan Semiconductor. That could actually be very difficult for Apple. And you've got the Amazon Prime Day sales, which might not be good. And you've got delivery orders by Tesla as well, probably not doing so well. I will talk about these next few opportunities that I'm looking at. So I really made a lot of slides here. And I don't have enough time to tell you everything that I have in mind. But the point that I'm having to tell you is that it's amazing how the markets today are giving us opportunities on the long side and on the short side. You have so many opportunities. Okay, let me just quickly answer a few questions here. What do you think about Paramount stock and Adidas? Paramount stock is, of course, they did well due to the Top Gun. Paramount Global was bought recently by Buffett as well. I think they bought it at $8. Let me take a look. Actually, I didn't check Paramount. But the thing about streaming is that I am not sure how to value these types of items, no? So it's a streaming play, I think, no? So actually, kung streaming, I prefer ano pa rin eh. I'm such old school. I still believe in Disney and Netflix. That's why I own Disney, $95. I think it's a good deal. Netflix, I think that you can get it at 160s. So at 200s, may sellers, 160s, 170s, dyan mo bibilihin. Adidas is going to have a same problem with Nike. I don't think you will overperform on Adidas. I want Adidas, I want Nike, but I don't think that is the best buy of the moment. The best buys of the moment, unfortunately, to be honest, is that you have to go to the heart of the crisis. The heart of this crisis is energy underinvestment, guys. So I think that the beautiful thing is that energy stocks are getting killed today with the false narrative that inflation is peaking. But how could we have an inflation peak because of a recession now? So you have to think about this. There's an inflation peak because there is a recession. Well, if there is a recession, it's a chicken and egg question, diba? That means that there is no demand. That means there is no sales in Amazon. That tells you that there will be layoffs in the future. If there will be layoffs, it's a vicious cycle. Who will consume again for your Amazon sales next year? Who's gonna buy another Amazon Prime? Who's gonna buy another Nike shoe? Who's gonna buy that Louis Vuitton? Now you might argue, nah, the rich people can always buy their Louis Vuittons. That's the hard thing, no? Only the rich gets richer, the poor gets poorer. Yes, I believe that too. So I think that you will see a mixed data. The first mixed data that you will see is people will be confounded. They will be confounded because Delta Airlines will show many tourists went out. These business travelers. Many people will be surprised in my view, but I'm not surprised because you're looking at data. Travelers are actually traveling. So that's why I'm a bit bullish on Airbnb because it got sold down and I think that they're actually going to report good numbers. But I will only be validated on August. That's the sad part. Baka on August, the Nasdaq is at 8,000 na. I don't know if the Nasdaq is going to be 10,000 by then. So, mauuna kasi yung Amazon and Tesla earnings. So, yun. Those are the risks. I am happy to always tell you the things that I'm looking at next week naman. So, continue to log in, watch on YouTube. By the way, I like Google. I believe that the digital giant platform, YouTube, is just growing and growing. And after the pandemic, more and more people became YouTube influencers. They realized, hey, I can probably make money just doing YouTube forever or TikTok forever. Well, that's not me. Obviously, I don't have enough viewers to make a career out of it. I just like to talk. I like to teach. And thank you for watching YouTube. To be very honest, I think we make about $100 to $200 a year. So on YouTube views. So that means that I could never survive on YouTube views. That said, I still, of course, believe that YouTube or Google Alphabet has a very strong platform. A lot of other advertisers like Minions, like a movie production, they would advertise a lot. They would advertise in social media, right? They'll advertise on Facebook, on Twitter, on Google. It's excellent. TikTok, all of these, no? So, and if they have a service they want to sell to you, some of the top influencers, the celebrity influencers, they'll use that, diba? So, mga Ivana Alawi, mga ganon. So, yan, may value ang Google. May value ang advertising. So, I wouldn't be surprised if this drop in the market, you will have one of the best opportunities to get the best businesses. Kasi obviously, hindi naman 90% down best business eh. Because you can buy Zillow at 90% down. Is that the best business? It is down 90% because there's a reason why. There's a reason why Google will only fall 30, 40, 50% down. Di mo kuha si Google ng $100 kahit gusto mo. Okay? You can't. I'm sorry. You can't. I think you can buy Google at about 1.7, 1.8. Now, of course, there is a time to be contrarian, but that time to be contrarian comes with enough data. I can only guide you that historically, sure, I'm already seeing bottoms in China. If that's a question, yeah, I do believe there is a bottoming out process in China. There is that massive easing that was just happening, diba? $220 billion printed money again, quantitative easing by China on infrastructure programs. That means it's going to go towards solar projects. Again, I'm saying that the hero, if you are a Captain Planet hero, you want to invest in Captain Planet, you have a lot of Chinese solar panels that is now going to dominate the market. So I'm not really surprised why Jinko Solar is up 90. Jinko Solar is like all-time high, to tell you the truth, no? I don't like that company because there's allegations of forced labor. Pero I cannot tell you that this stock is not going to go to the moon. Because nowadays, guys, China is where we all buy our solar panels. Naging made in China lahat ng solar panels. Pilipinas, abroad, Japan, tanong mo yung mga aslag, tanong mo yung mga ASEN, mga SPNEC, malamang Jinko Solar yan. Kung hindi man, Trina Solar yan or mga Maxion siguro. China panel yan. Because it's cheaper. So, if the world is gonna invest in solar, then the owning the solar panels, of course, makes sense. So yun, those are also ideas that I will plan within the next few months. So antabay lang tayo, guys. Maraming opportunities in a bear market. Thank you for watching, and I hope you share this to your friends, and I hope that you remain staying focused. Hindi ka kailangan long lagi. Pwede ka mag-long, pwede ka mag-short, di ba? But always stay focused also on the long term. Saan ba tayo patungo? May bumps, but we will always go up. There will be best businesses that will capture the greatest companies, no? Do you not want to buy Instagram at 70% below the top or 60% price cut in half? Not bad. So think about those things then. Netflix is in a competition. So hirap yan. The streaming war, I think, medyo difficult. Maraming question mark. They have to prove that people will continue to subscribe to their content faced with the fact na may Amazon Prime naman, may Disney streaming naman, may Paramount na Peacock. Peacock is CNBC. May HBO Max. I'm interested to subscribe to HBO Max soon. Kasi parang interesting yung mga shows nila. Succession, tapos meron si HBO Max na darating na Jon Snow's sequel, which is Game of Thrones sequel. Maraming good shows ang HBO. So yun, that's it. See you again. Bye-bye.